Welcome to the Chaim Investment Advisors podcast. This is Chaim Victor Schramm speaking, and I'm here with Pablo Lash.
Hey, how's it going, guys?
And today we are talking about interest rates, which is a topic that really fits into our macroeconomics podcast series rubric. And it's a foundational topic for just talking about money in general. Last time we talked about money itself. Now we're talking about effectively the price of money, which is interest rates.
Yeah, totally. No, I think this is a great topic. I also think it's good to have a solid and comprehensive understanding of interest rates, and it will help you in any sort of, even if you're like not really trying to delve into investment, just understanding interest rates in general will give you better financial literacy. So,
Yeah, it is such a foundational topic, and because of that, we should start with actually defining interest rates so nobody gets totally lost from the very beginning.
yeah, that
Hey,
sounds
you
like a good
you
idea.
had you had a great definition of interest rates.
Yeah, so like an interest rate really is the cost of sort of renting an asset. Um, you need to return this asset at some point, but usually, almost always, and I would recommend if anyone's borrowing something from you, that you get something in return. And we're going to talk a little bit about the reasons why. It's not just people may think this is just greed, but when we talk about what goes into an interest rate and the sort of like built-in premiums, it'll make more sense where how that number is drawn up and why someone might charge you to borrow their asset for a while.
Indeed, and I've also heard interest rates as the price of money. I think that's like kind of a classic
It's
one
very
that
much
people
so.
use,
Very much
and
so.
I've always related to that. That sounds, pretty accurate to me, and people see it reflected in the interest rates that they get charged for various things. And, Nordstrom Rack costs a little bit more money than a car, which is self-collateralizing if they ever need to take it away from you.
Totally, totally.
So,
No, yeah,
yeah,
and like thinking of it as the cost of money makes a lot of sense if you just think of in terms of like when the government and this is we're right around the voting time, so you'll see a lot of measures when the government's trying to raise money, right? They're oftentimes doing it through bonds, and so what they're doing is like raising that money and then selling those bonds, and then we are paying interest rates. So
indeed. So interest rates, how are they set? That's the probably largest question about interest rates, and the source of the most mythology around interest rates in popular culture, and just how interest rates are talked about. So yeah, how are interest rates set? Because that's the starting point of this whole discussion, really.
totally, I agree. So I mean, there's a couple of premiums, that go into the interest rate. So this is what you pay for different variables, right? And so one of those premiums is the inflation premium, right? So um, since the Fed now targets like 2% inflation, that's sort of the expected inflation. Before the Fed didn't target inflation, so there could be inflation or deflation. There still can be inflation or deflation, but the Fed wants it one way, so they work very hard to,
They
to try to make it go that way.
do their
And so that's
best.
one. Yeah, that's one premium that you're paying. So it's like, if I loan Victor $100, if he's like, I'm going to pay you back in 20 years, maybe I want a little bit more than $100 back because, like, I mean, man, like it's been 20 years and I don't think my $100 is going to go as far as it used to. So that's like one of the premiums. And the other three premiums, I kind of like separate those off because the inflation premium is almost always there. So it's like very hard to get rid of. And I think the other premiums are often there. The other premiums are the default risk. That's just basically, you know, Victor's decided to screw Pablo. I'm not paying it back. You know what I'm saying?
Yeah.
And they're like, man, $100. I thought I was worth more than that. And then after that, we have the maturity premium, and this is a very real premium. I think Victor and I will talk about in a second, which is, you know, over 20 years, a lot of things could happen. Maybe Victor totally intends to pay you back, and something happens. He just doesn't have the money, or like God forbid, something happens to Victor. I never want that to happen, so knock on wood. But like things can happen between now and 20 years, right? And so
Yes.
that's a maturity premium. And then we have a liquidity premium, which is basically like what it sounds like. It's just like, look, can I go and sell Victor's debt on the market? And I can't, because most people are just like, who is Victor? Who is Victor? Victor is my friend. I owe him $100. Well, you know what, buddy, you're stuck with that. So the liquidity premium is the other part of the interest rate, which, don't worry, for most private markets, the liquidity premium is there, but they're often able to sell and buy debt. So those markets are pretty active.
So, one topic that I think gets a lot more attention than it probably deserves in terms of like how weighty it really is in the long term of, how all decisions around interest rates are made is what role is the Fed playing, the Federal Reserve, in this whole process? Because, a lot of times, like if I walked up to 100 people and said, the Federal Reserve sets the interest rate, probably a lot of people would agree with that. And a lot of people wouldn't be able to think of why that might not be the case.
Yeah, no, that's a good point.
So it's something that it comes up quite often when I'm talking to clients or just people who want to learn more about how money works. They want to know, well, what role does the Fed play if it doesn't set? Of course, it can't set all of the interest rates, but where does it come in?
Yeah, and in fact, like the answer, to that is like understanding that the interest rate is really a market, right? And like almost all markets, it's set by the participants of the market, right? So what the Fed can do is influence that market, and particularly what they influence is the fund rate, which is the rate at which banks loan each other money. And usually that is how they are trying to influence the interest rate. Though lately they've done a lot more quantitative easing, which they say they only use during a financial crisis. So I guess we are in a permanent financial crisis. Yeah. It's been about 12 years now. But yeah, that's like usually how they're setting that. They're usually trying to set a floor or a ceiling, and without getting too technical, basically the way they do that is by offering a rate which makes it desirable either to borrow money from them or desirable to hold their money. Right, the interest rate they're going to pay you is going to be better than another bank or something. So, but like you said, they don't set the interest rate, and I think that an important point that you and I were talking about earlier is that like when private markets are talking about interest rates, they do not even use the Fed funds rate to measure them. So I don't think the Fed has as much influence on the interest rate as it would like. Yeah, no, that's I would say that.
Yeah, so then just to follow up on that, when let's say you're going to create a mortgage with somebody, people aren't referencing what the Federal Reserve thinks, or I mean, maybe they are to some extent, but mostly they're actually referencing what's called the London Interbank Offering Rate, or LIBOR, if you've heard that. And a lot of times you'll actually receive your quote in, oh, your LIBOR times 9 or LIBOR times 60 or whatever it is. That's actually the reference point. And I do think that's kind of funny, the kind of mismatch in perception. Oh, the Fed is setting interest rates, but really is actually a British bank industry standard that is determining how, or let's just call it, that's the reference index that people are using to make interest rate decisions kind of outside of the influence of the Fed, which is most interest rates
right.
are not actually being hands-on touched by the Fed. And the government uses other ways of in trying to influence interest rates. One of them being the IRS's guidelines on how much do you have to charge somebody if you just loan them money as a friend or your mom or whoever it is. If you charge no interest rate at all, that's called a gift according to the IRS. And so they publish guidelines of how much do you have to charge per month, per year, whatever it is, for the appropriate term and general kind of risk level
And then
involved with it.
that rate is like fairly low, right? I mean, I imagine that it would be
Very
low
low.
because if
It's
it was
very
like
low.
if it was if it was high, it would really upend some of the interest rate markets to be like, oh, you can charge this. This is the minimum you must charge. Well, that's weird because I just go out in the private market and I'm charging after that. So yeah, like that rate's going to be pretty low, but like I think that there's probably some benefits. You always want to talk to an accountant or a tax professional, and you go over these sort of things. But there could be some benefits, especially if it might even cost you money to
Yeah.
to loan someone. But there's another important reason I think, right, that we when discussing loaning money to friends or family or people you know, that you might want to charge something, and it's kind of like what we talked about, the things that are built into there. Um, like I think that my father had a great saying, which is that like if you loan someone money who's your friend or family, you should think of it as a gift. That way you're not worried about getting it back or if they're going to pay you or not, because obviously there can be a lot of drama that comes from that, but also there's a lot of things that can just happen in general, right? So
Yes.
yeah.
Yeah, and so the Fed, or sorry, the IRS, they also try to influence that and make it difficult to loan money for free, although people still loan money for free, obviously, and that is that's kind of maybe a topic of another podcast, which is how free loan societies work. That's always something that fascinates me, especially with halakhic finances. How you're supposed to do it. So that is an interesting one. But at the foundation of even halakhic finance is the acknowledgement that if you are loaning money to somebody for free, you are losing money.
100%. Yeah.
And this is acknowledged by halakhic thought. It's not, nobody is pretending that it's a break even. You know that it is a form of a good deed.
Right.
And that's why, it's a good deed. That's literally the category it falls under, Gamlut Chasadim, good deed. So even there, in ancient finance, when we're talking about free loans and not charging interest, we still know that, hey, if you're not charging money, you're losing money.
100%. Like we said, if you're loaning money to someone, let's even say like some scenario where there's deflation and somehow you think the money's gonna be worth more. There, even if this person is definitely going to pay you back, right? There are just things that can happen and will happen, and those are statistical odds that you're just going against. It. The numbers are the numbers, right? So I mean, yeah, you were in some sense giving away money, and that might be a good way to see it if you're not actually engaged in some sort of business transaction. Save you some heartache.
Well, this is actually personal loans. That's a really interesting category when you talk about the four risk premia, especially default risk. So sometimes
Right.
people say, well, they forget about the other categories of risk easily, and they say, well, this is the one that obviously people are most worried about is default risk, because that's the risk you just don't get it at all.
Yeah.
Inflation risk, you get something, it may be worth a lot less. Time preference, well, time preferences, they can be fudged on other side depending on conditions. But I mean, default risk is, are you going to get it or not? That's a
Are you
big
going to
one.
get paid or not? And I think you bring up an important point. When you are loaning to your friends, you're not loaning at scale like a bank is, where it's like, look, if one guy doesn't pay me, I make up for that because all these people paid me. And so the default premium is picked up by everyone else. Everyone else is picking up that tab. If I'm only loaning to one or two friends over the course of 10 years, it's unlikely that if one of them doesn't pay me, anyone's going to pay me enough money to make up for that. So.
Well, and it brings up an interesting topic about how much do we know about each other, and how much can a financial institution know. I know as an advisor, I have a much longer and more drawn out process than most advisors for learning who people are. And at the end of the day, I spend a few hours getting to really know about somebody's financial life, and that's more than a lot of advisors do. And banks as well. They might spend, sometimes you get those really fast, approved online in 30-minute, offers. They haven't spent very much time trying to figure you out.
And they have an
That
interest rate that reflects
Yeah,
that.
exactly. That's kind of one reason why, arguably, um, people might be able to set different rates for each other than a bank can, because a bank is doing this thousands, if you're JP Morgan, millions of times. Uh,
Yeah, totally,
and
totally.
I might loan, like one person or two people money that I know quite well, and actually know pretty much everything there is to know about the person and who they are. There's social accountability aspects to it, um, that might make it easier for me to determine, yeah, this person should be cheaper. But at the end of the day, when people are operating big markets for money, which is what big banks do, yeah, there's a operating cost where people really do default. Um,
Yeah.
Usually, not too often. This year, it's been actually the highest been in the last 10 years for sure.
But I think that like you bring up sort of a good point, which is that sometimes you see people and they say, look, why can't my interest rate be lower? Why is it that someone who has more assets has a lower interest rate? Or why is like, what is this judgment maybe like they feel like the financial industry is making against them? And it's really not a judgment, right? It's the same with like school loans. I think actually school loans might be artificially low. I think that like based on the
Yeah.
default rate, they probably should be higher. So then in fact, school loans are probably like losing money for anyone who's holding those. But like the point is that like it's not like the personal element is just not there. Just like you're saying, like when I know someone, I know this person, I have an idea who they are, how credible they are, how much money they've borrowed from other people, and things of that nature. But the personal element's not there. They're businesses and they want to make money, but they also would like to break even if they can't make money, right? And so
Yeah.
people like, of course, lots of businesses have made a lot of money in our stock markets over the last 20 and 30 years. But there are times where you go and look at things like this, whether it's like loans or insurance is another great example, where you see that this is a place where businesses can quickly lose a lot of money, even when they have very intelligent people working for them.
Yes. And so when somebody is making uh, interest rate decisions, like we talked about the four categories of risk that they're thinking about, when countries are thinking about interest rates, they kind of have a totally different toolbox that they're working with. Like when we do talk about how the Fed it makes some interventions, the IRS has its means of intervening. Um, Policymakers definitely have interest rates in mind as they are making decisions. One thing that I think is interesting to mention about interest rates is demographics. That's one of the toolboxes or things in the toolbox that policymakers and analysts are looking at. Because sometimes, actually, I hear this just all of the time. Ideas that, oh, interest rates will go to X point or Y point, they'll come back up, they'll go down. And a lot of the time, people aren't actually thinking about how important demographics are. So something that's been going on in the interest rate world, I actually wrote an article about it called, God, what was it called? It was something about negative interest rates,
Right.
and talking about how, yeah, it shouldn't make sense that this is happening, but it really does. The further you dig into the topic, it does make sense. There's negative interest rates in the world, and demographics are a huge part of that. Where you have declining populations, you'll almost universally have low or negative interest rates at this point. Japan, Germany, Poland, Russia, you name it, the whole EU has declining populations, and the majority of their interest rates are negative. In Denmark, you can get a negative interest rate mortgage on your house. You could get paid to take out of a mortgage. That's how desperate they are financially. And that, people who say, oh, maybe it'll come back. Well, I don't think that they are thinking about the fact that they can't. If we think about how intimately demographics and interest rates at the top level, at a kind of macro scale, an inter-country relationship scale of one interest rate of one country to another, and how that affects currencies and money markets. Well, yeah, demographics are something that actually has to be thought about, and when people are making predictions, they should think about it.
Yeah, there's like fundamental facts, factors that are helping to build the interest rate. And, again, it goes back to like, if the demand's not there, the demand's not there. That's like true for interest rates, just like it's true for any other market, right? And so, like, when you have, I think when you're talking about demographics and like the effect on interest rates, when you have demographics that, perhaps sometimes are called like inversed, or they're not growing anymore, it's not that effect is sort of comprehensive, right? So I mean, the demand for growth is going to be lower, right? The demand for growth is lower, then the demand for investment is going to be lower. An investment should equal savings, right? So like that's the demand for money, really. So you're gonna, there's like it's fundamental in a way that like is difficult to avoid. Like you might have some crafty central bank that thinks that they can do something temporarily, but oftentimes, they can do a lot less than they believe they can do. It's one of those situations I like to think of, like, it's easy to mess up. It's like very hard to make something good happen. So really you can just maintain the status quo, or you can mess it up, So yeah, 100% I agree with that.
Yeah, because one thing that I've always been interested in with that topic is, as a population is declining, let's say that capital is generally the same. There's the amount of retained deferred consumption in aggregate is about the same. People set away a certain amount of money over their lifetimes, and it's been retained as kind of in the big piggy bank, the financial markets. But now there's a lot fewer people to need that capital. Right. And so in a way, interest rates have to come down because there's more capital than is needed in most modern post-industrial countries where the population is declining. In fact, when you look at a place like Japan, what does Japan do with its capital? Oh, it first of all tries to tinker with global currency markets. That's like the number one thing it does with its money. It is financial engineering on an international scale. And the second thing that it does is put capital in other countries' financial markets. So you've got the Bank of Japan owning American, passive ETF indexes. You've got Japanese banks buy American venture capital funds, companies that have never turned a dime in profit.
Yeah.
You get people seeking a way to, like, how can I deploy this capital in any way? Yeah, of course you're going to get negative interest rates over the long run.
Yeah, and that effect is like compounded, especially when there's dampening of innovation or dampening of growth, because what you're looking at when you look at some sort of investment and asset, right, is that you're getting paid a risk premium over what might be like a really safe, what's called like the risk-free rate is like that interest rate that you're getting from the government, right? And so anytime you're dampening growth or you're dampening innovation, that's actually is compounding the effect. So if you have like an inverse population, and then you're also not really willing to put your capital in risky places,
Absolutely.
There should be no surprise to anyone. I'm not saying that like we all know the answers about how to get out of it, but like we certainly can see what the situation is, right?
Well, yeah, and in a lot of ways, the answer comes back to something really fundamental to macroeconomics. It's kind of like running through this series, and that is at the end of the day, all of these things, the amount of money, how money's made, price of money, it all comes down to us and how we are acting economically. Uh,
Definitely.
if we as people, as a nation, as a planet, what have you, are acting in inefficient ways, then all of those tools echo that in a specific way. And if we are being, hyper efficient in other ways, all those tools uh, look a different way entirely. You get the price of money collapses. When we think of uh, interest rates as the price of money, then yeah, it starts to make a lot of sense. You'd get a negative interest rate on most of continental Europe because there's more money than there is demand for money.
Right. And I think that like um, some of that lack of demand is policy based. It's just where they can
Oh,
put
for
their
sure.
money and what they can do with it. And so, to be honest, like, without getting like, we shouldn't all look at the situation very dire because the truth is there are answers. I believe there are answers for these countries and these people. And there are markets that are not even close to being saturated. There are places to
Yes.
innovate, but you're not even close to like, having enough competitors. There are so many places and you can put your money. The thing is that we get comfortable though, and it requires risk. And the fact is, if you don't want to risk anything, and and you have a declining population, you know what I'm saying? Then you're going to have too much capital. Like there's no way around it. Like
Yeah.
I don't know what else you would expect in that situation. Like you said,
Yeah.
they were putting their money in other markets, and where the and it's a great example of like why the U.S. has fared a little bit better than those places is because we still have, not what I would think is ideal in growth and like business, but we still have an available place to put capital. There is still like Silicon Valley, like is in the United States, right? So I mean, we have places where people can innovate and build new business, and find new. Really, it's about like the stewardship of capital, right? I think
Yeah.
that is like a sort of important factor that sometimes people overlook, right?
Well, yeah. So you get stewardship and you get how we all individually, you know, uh, in aggregate are acting. Those are, at the end of the day, what really is driving all of the macroeconomic discussion. And it's easy to forget that. It's easy to talk
Yeah.
so specifically about each tool and how it's used and this policy bad, this policy bad. At the
Right.
end of the day, if we are all um, acting in certain ways, then things are just going to look certain ways. There's nothing that
100%.
policymakers have been able to do in continental Europe to turn around the situation there. Nothing.
Yeah, a good example, like during our current crisis, the idea that like they were somehow going to spur demand. It wasn't that there was like in aggregate, it wasn't a lack of demand. In
Yes.
aggregate, businesses were shut down. So this is like a fundamental like example of like why it does matter, like how we act and what we do, and that fact is that there are times where people and governments and institutions can influence things, but rarely for very long and rarely very much, So
Yeah, and that is I mean, COVID-19's one of, it's going to be fascinating to see like 10 years from now how this epic is understood, especially in terms
yeah,
of macroeconomics. Like you had mentioned, that it's just goes completely ignored all the time. But, politicians talk about, oh, we got to have jobs, we got to have growth, got to have this. But it's like, oh, you got to have more demand. But look, man,
yeah.
like,
We make the demand. Yeah,
yeah, yeah.
like
Nobody's doing anything, man. I mean, yeah, society is at a bit of a standstill, so it becomes weird to even talk about these terms when uh, all of those terms are and ideas and tools are forgetting the fact that at the end of the day, if we're not being economically active and
yeah,
we can't be, then no, the
yeah.
economy cannot be good. There's nothing
Yeah,
you could do.
there's literally nothing you can do. This is 100% correct. So I think it is kind of a funny thing. especially because um, you know, politicians are probably, I think most politicians are lawyers, so they're probably like, pretty intelligent people, but I've often found that like they don't entirely understand economics or finances. So and it was both parties, as soon as both parties came out and started talking about spurring demand, I was a little bit confused. I was like, but the demand is not what left. It was the
Yeah.
supply that left, so like,
It was, yeah, I had the same reaction whenever I hear it, like, oh, gotta get that demand up. Come
yeah,
on, man. Like,
yeah.
what? Demand to go to GameStop? I mean, but,
Yeah,
or demand for, I don't really understand.
exactly. And like in demand that's not there in terms of like, people who are like, hey, I don't want to go to a crowded movie theater. You know what I'm saying? You
Yeah,
can't get that demand up. There's nothing to do that like that person has a risk preference that says like, I'd rather be safe and stay home. And so
yeah,
I just think it's like a very funny way to look at it because their effect on demand, and this is true generally, I think also, but it's just especially just pertinent in this case that like their effect on demand isn't what they believe it is. And I think that like just in a sort of like in keeping with the interest rates, um, you always hear this notion that like, hey, we slash interest rates, and in the short term, that's going to be inflationary. It's going to allow money, people access to capital and things of that nature. And this is not always the case. I don't think that like the effect is nearly as large as like the government would like to be, and in the long term, it is like definitely not the case. So
yeah.
yeah, I mean, not to like spend all my time knocking the feds because those are intelligent people, and then they have really really tough jobs, which is why they get so many gray hairs as soon as they like become presidents of banks, right? But I do think that like that as a policy, it's exaggerated in the media how effective that policy is and the effect on us. When, like you're saying, the fundamentals, the underlying facts of like you and I and other people, our demand is like really a much bigger factor in driving the economy, right? And driving interest rates.
Well, yeah, I think it is going to be, this is one time where I have no idea what to expect out of the interest rate moves and their impact, because when you say, oh, we're going to have like lower interest rates, people borrow more. But are they going to borrow to buy a new car that's better for commuting? No, they're not, because they're not commuting at all. Are they? Maybe they will borrow to buy a house outside the city, but that's pretty deflationary for inner city economics. And is that the real? Is that the real priority of policymakers? No, it's
And
not.
yeah, no, I agree. I think
That's
that
an
like
unintended consequence, if anything.
if you look and you go see that like for your like your credit, like your or like whatever wherever your bank, wherever you're borrowing money, that the interest rate has moved 1.5%. I do not think that that's enough for me to suddenly make risky decisions that I wasn't making before
Yes.
in a time where the economy is like sort of in a recession really. So I don't think that like I go 1.5%. But there was all these decisions which I was like I wasn't really willing to take on that risk. But now that I see that I'm getting 1.5% better, I think I will.
Yeah.
And so that's another reason I think that that's kind of that story or that narrative that is told in the media is like not as genuine as they say it is. So.
Well, no, because I mean, there has not been, I would say, an interest rate in the last 15 years that really probably would deter somebody entirely
Right.
from making a. Oh, now that it went from 3 to 1.9.
Yeah.
Yes, 3% was deterring me, but now, now that
Yeah,
it's
exactly.
1.9, I'm going
Yeah.
for it. Now,
Yeah.
that's not really how that works.
100%. Yeah. That's just
And,
like
and
that's just sort of fantastical
in
thinking.
the past, maybe it did. I mean, in the past, one thing I want to link, if if you're looking at this on the website, is a chart from Visual Capitalist uh, of historical interest rates, because I
Right.
think that would be a great kind of appendix A for listeners to check out to this conversation. And the when you think as you look at that chart in terms of interest rates are the price of money. Just watch how it has collapsed over the last 200 years. It's pretty mind-blowing.
And that chart, I think, is like indexed, right? It's adjusted for inflation, right?
Yeah.
Yeah, so I think like that's another just brief point, which most listeners probably are familiar with this, but we're always looking at the real rate and a nominal rate based on some sort of index, And it's possible that the real rate and the nominal rate are not in the same place, are not even close to being in the same place. In fact, it's likely that they're not in the same place.
Yeah.
You can have real rates and nominal rates where one of them is negative and one of them is positive, just based on what's going on in that economy. So yeah, I think that like that. Actually, I've seen that chart. I think it's a great visual representation of interest rates over the last 100 years or so.
Well, yeah, actually, that's such a good point about real and nominal rates that often, especially these days, it's not discussed because we're so used to negative real rates. It didn't always used to be this way. When I wrote that article about negative interest rates, one of the comments that I got from people that I thought it was interesting, people wanted to have a discussion about, we've had negative real rates for quite some time. That's kind of the norm now. And that was absolutely true. That matters a lot, but to me, negative nominal interest rates is a whole different thing. It's, I think the long term. Well, I have a lot of thoughts on negative interest rates. They really belong. You just read that article.
Yeah, totally. Like,
I should do an update to it.
Yeah, maybe down the road we actually have a lot of topics, but maybe down the road we can discuss the wonders of nominal negative interest rates.
Well, yeah, and especially, probably by the time we get to it, we'll have some societal impacts. We'll be able to point to say, yeah, that happened because of this. It's always difficult early on to say because, sometimes policymakers make an extreme policy and 3 months later they say, see, it worked. But really the scale of looking at policy impacts when it comes to macroeconomics is more like 10 years. You gotta look, not in the near term to see the impacts. They do continue on for at least a decade most of the time when these decisions are made.
No, you bring up a great point. I always think about that. Again, people will talk about one person or another having been good or bad for the economy. And I'm like, it's unlikely that what he's done you're even going to know about until much later, like even now when we've had a lot of presidents serving like 2 terms, it's still a very exaggerated and, a delayed effect. So yeah, I always think that's funny. It's like, this, like, and then they'll say it like, oh, like 2 years ago I was great for the economy. And it's like, it's hard to even say who was good for the economy 2 years ago. And it goes the other way around. It's like, this guy ruined the economy. It's like, did he really ruin the economy? It's once again, you're giving this too much credit to people who are really like more figureheads. Like you say, there are fundamental factors that affect the economy. There are definitely, without a doubt, there are things like the Fed can do. Quantitative easing is like for sure a short-term inflationary effect, right? I mean, when they're buying up assets, or people know they're buying up assets. I think we talked about this the other day. I saw in Bloomberg they said the Fed puts are baked into the price, which means that the market basically said, we know that if this goes too low, the Feds will buy it.
Yeah.
And so, which is interesting.
And they proved them right. They even bought junk bonds. That's how true that is. They in March bought junk bonds because they went too low.
And then generally, like my thing when I think about the Fed is like that. I think that there are places where they can be helpful. I'm not definitely I think that oftentimes people get confused about it's a semi-private bank and there's a lot of sort of conspiracy theory around that, and that's not at all what I'm trying to say. They have one of the best sort of governance. All of their money is put into a blind trust. These people are only doing what they think is right for the economy. At the same time, I think, especially in macroeconomics and economies at large, one of those things that the more you mess with it, it's kind of like when, I don't know if you had that old school black and white TV when you were a kid, you're trying to find a channel or something, And then the more you mess with things, then like things just start to get really fuzzy, and you're like, man, this looks way worse than when I started. And there's always that danger when you're doing a lot of any sort of macroeconomic activities, any sort of macroeconomic policies, because it's a dynamic and living thing. It's all of us and all of our decisions together. So
Yes, and I will just mention one often forgotten point about policies, the timelines that we kind of rate the performance on, and especially interest rates, is
right,
that when it comes to interest rates, well, that is the driver of compounding uh, interest.
right, right.
So if you've ever heard of or looked into the impact of compounding interest rates, yeah, when you tinker with the interest rate in any way, it makes a huge difference 10 years later.
It definitely does, and it definitely, I think, again, looking at that long-term thing where you go back to that well of like, hey, we need to lower interest rates, or we need to like quickly fix interest rates right now. Over the long run, what you're saying in an opportunity cost situation is that like, if you're like someone who's more risky, you want to invest in stocks or something, right? You only care about the difference between, like, that's what you're looking at. You're like, what's the difference? That's the risk premium of putting your money somewhere riskier, right? If the rate for interest for risk-free money is low, then naturally the return on stocks and everything has to be lower. That's the growth that like people talk about.
Yeah.
So often I think they get in this, like, it's almost this thing where like now they've done something, and I think that some people probably wish they could have undone it. Sometimes you just have to take your medicine. So that's like, again, this is just like sort of a broad overview of interest rates, I guess. So I don't want to get too in depth in it. We'll probably have other podcasts where we talk more about that sort of thing. But
well, yeah, that is a fascinating one, especially when you talk about the relationship between stocks and bonds. If the Fed comes out and says, "Man, we're going to have monster interest rates now. The Fed funds rate 6.5%. Bonds are going to be the best investment." It actually drastically impacts equities, because then people say, "Whoa, man, I can get 6.5% from the federal government with no default risk. Great."
Yeah, I mean, a lot more money from these. Like, yeah, exactly. It's 100% right. I think that you're not happy now. It's with 7.5 from the S&P 500. You're like, look, that's only 1% better, and you come along with all this risk. So yeah,
well, yeah,
I think this is true. I think
because people, when the interest rates are low at the federal level, they say, "Hey, now I'm going to buy utility stocks because the dividend rate on utility stocks is maybe 4.5%, and that's X or Y spread over the 10-year Treasury," and that is a useful way to think about how your investments are performing. I don't really advocate for those kinds of like portfolio micromanaging moves, because they tend to get washed out so quickly.
Right.
Longer than people actually are making decisions on in terms of a time frame. These are usually temporary, ideally, tools. Although, over the last, who knows anymore?
Yeah, I think that like, again, like you're mentioning something that like we talked about how the Fed puts are like baked into the price, and some of this, like, it's not necessarily cynicism, but some of this is like maybe disbelief about the Fed, is because if you go back 20 years, you would never even imagine the Fed doing these sort of things, because you would never imagine them sort of announcing for 2 years, hey, we're not going to raise the interest rate. Like, you probably wouldn't really imagine them announcing that for like a year, So it signals a shift in their thinking generally, I would say.
A pretty major one.
And a surprising one too, because it's exactly the sort of thing where, it's just not something you would see for sure. I mean, I remember when I was like in my first economics class, I think you're talking about, the Fed, and the professor was like, basically, he tries to say as little as possible because he doesn't want to disturb the markets, And so you can sort of contrast that with like now we have a chairman who's come out and said like, look, for 2 years, I'm not raising the interest rates. So that's a very different attitude for sure.
Well, yeah, because ideally the Fed is not a major driver of entire market performance.
Yeah.
It should
Ideally,
not
that is
be.
true.
It should not be. If you have a sound, functional economy that is, based on real fundamental productivity and growth and
100%.
efficiency, it really shouldn't matter that much. But we are in pretty weird time in terms of those things. So
In a surprising time for sure. And the last thing I think I would say is when I heard, I think it was Lash from
Kashkari, yeah,
Kashkari, that's right. He's in Minneapolis, right?
that's right.
Yeah, and he came out and said that moral hazard
Does not exist.
does not exist, was not a concern. And so, again, and for anyone who's interested, there are a lot of great resources and places you can go look up on the history of the Fed. But these sort of things are really sort of unprecedented.
They are.
No one would ever guess the Fed would come out and do these sort of things because it's a total shift in mindset from like a more reserved, like let's do things where we can to help maintain the economy to the expectation that they're an active player, and then active in the literal sense because they actually are buying up assets. So
yeah, and I think it's fair to be skeptical of the Fed from many different angles. You could, some people would say, "Oh, the Fed has gone this really hyper progressive direction." I don't tend to think that's true necessarily. Like, I don't think that the Fed's moves have actually produced progressive results, if progressive means
right.
income inequality and wealth inequality.
Yeah,
those things are not better.
Agreed. I don't even
worse.
necessarily know that like that's their intent. Yeah, I mean, again, it's not like just to knock them. It's just a little unprecedented. And there are people I think that you and I both respect and that we like or we follow. But this is definitely unprecedented. And I think it's one of those things, like where it's good to have good financial insight, because this is something that actually affects people's financial lives and their financial planning. We're in a situation where, if you're not really if you really don't know what to expect from the Fed, it 100% will is an effect on your life, and you don't want that to be to hurt you or hurt you in the long run. So.
Well, yeah, and too much Fed skepticism also leads to bad things. It's easy to overdose on Federal Reserve skepticism and think that you should own just a bunch of gold. I mean, just as a prime example of where that thinking leads for some people, you get that.
Regardless of what you say about the Fed, the fact is that it is the risk-free rate of return. That is in the financial world, that is what we call it when you're looking at targets for growth. That is the lowest benchmark you use. In other words, if this is just some good general advice, if you ever go and talk to someone and they're offering you less than the risk-free return, you should be concerned because that's just a great opportunity for arbitrage for them.
Well, yeah.
In fact, kind of ironically, banks did this in the last crisis where they were given money in order to create liquidity. They said, "Hey, we need to get some liquidity in the capital markets," and they went and they bought bonds and T-notes and all sorts of things from the Fed. So basically, they made money. They're just "Yeah, we're making money. We're fine. We parked it where we want to keep it in the place where we know we're going to get paid." And so, yes. Like you said, we can't have too much skepticism because it is the place where everyone, in fact, in the world goes. And a great example, if you want to see why, you can look at places like Argentina or Greece or Venezuela, or there's just these places. In Venezuela, I think that right now it's 40%. They're paying on their bonds, 40%, and it doesn't even keep up with inflation. So you're losing money, despite the fact that you're getting 40%. So, and in Argentina, they have. Go ahead.
Oh, they actually defaulted. only a couple years ago. So, as an investor, you shouldn't be that excited about that interest rate.
Yeah. This is a great example. Look, everyone who's still here with us, you can see now that the default premium was not high enough to cover their actual defaults. So,
yes, exactly. Yeah, so I think this is a pretty good first glimpse at how interest rates work, how people think about interest rates in the finance world, a little bit about how the Fed really works, and some of the decision making that goes on around both creating interest rates and also reacting to interest rates. We discussed some of that. So yeah, I think this is a good intro, and probably we will do more with interest rates because it is such a foundational concept, and we'll definitely do more with this series because it's a lot of fun.
Yeah, no, definitely.
With
And like you said,
macroeconomics.
there probably is a lot. We could talk about interest rates for a long time. Like there are just so many places and so many ways you can look at it. And I think, again, if this is all you listen to and you're like, look, that's my fill. I don't need any more, financial jargon than that. Then like that's great. You probably are still better informed than a lot of people. So I mean, I think it's a good podcast to listen to.
Yeah, and I guess tune in next time. We're going to talk about. We have a lot of podcasts planned.
Which we do. I think that we have an ESG one that we want to do.
Yeah.
And we have a retirement one, and we do really have Chaim has Victor has the list, so and so he knows there's probably like 10 topics on there.
Every time we record one of these beforehand, we think of like 2 more, so it's kind of like the Hydra at this point.
Yeah,
which is great. You'll have lots to listen to.
we will be aiming for 2 a month. I think is like a decent.
I think manageable, and I mean these are a lot of fun for us, so
Totally.
Enjoyable as well.
Definitely, I enjoy myself. We appreciate you listening.
Yeah, and talk to you next time.